Internal sources of finance are funds that come from within the business itself. This could be the owner's savings when the business first starts. It could be retained profit, which is profit that is kept in the business instead of being paid out to owners. It could also come from selling assets that the business no longer needs. Internal finance is often seen as safer because there is no debt to repay and no loss of control. The business is using its own money, so there is less risk from lenders or outside influence. However, internal finance is usually limited. A small business can only use the money it already has. External sources of finance come from outside the business. These include bank loans, trade credit, overdrafts, share capital, and money from investors. External finance allows a business to grow more quickly because larger amounts of money are often available. However, it also comes with risks. Loans must be repaid, usually with interest, and shareholders may expect dividends or influence over business decisions. In GCSE and IGCSE business exams, it's important to show balance. Internal finance gives the business more control and usually involves lower risk, but it can limit growth. External finance allows expansion, but it increases risk and creates obligations. There is no single best source of finance. The right choice depends on the size of the business, what the money is needed for, and how confident the owner is about future income. For example, if a business is already experiencing cash flow problems, taking out a bank loan that must be repaid every month is unlikely to be the best course of action. On the other hand, if a business is profitable, meeting its existing repayments, and has a healthy surplus, a bank loan might be the right move to support growth. But even if a business chooses the right type of expenditure and secures finance from the right source, there is still one major issue that causes businesses to fail, and that is cash flow. If you found this helpful, hit like and subscribe so you don't miss the next part in our finance series.